You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 14th of March 2026 and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Diageo, Mony Group, Aston Martin, Rightmove, Haleon, and our US listed company of the week is Wix. John, do you want to start by telling us what Sir Drastic Dave has been up to?
Yes, no, absolutely. So this is for Diageo, which is one of the world's biggest spirits manufacturers. They had their half-year results out now. I was going to say last week, but it's actually now a couple of weeks ago. And they reported first half net sales of $10.5 billion, which was down 2.8% on an organic basis, with volumes and average selling prices both falling. This was driven by declines in North America and Asia Pacific, which was more than offset by growth in other regions. Underlying operating profit fell by 2.8% to $3.3 billion, with lower marketing investment helping to offset the impact of higher tariff costs. Free cash flow fell by around $200 million to $1.5 billion, and net debt remained broadly flat at $21.7 billion. Full-year guidance has been lowered again, with organic net sales now expected to decline between 2 and 3%. And previously, it was guided as flat to slightly down. Organic operating profit growth is now expected to be flat to low single digits, and previously that was mid-single digits. The interim dividend has been cut by 20 cents a share, which is down 51%. And the shares were down over 6% in early trading. In terms of valuation, the group have a market cap of £32 billion and they trade at 15 times forward earnings compared to the 10-year average of nearly 21. And the prospective dividend yield, in fact, I'll have to calculate this because I don't think it's 4.1% anymore. I thought these results were disappointing. They are worse than we expected, but we have got used to that in recent years. The big news is obviously that Sir Dave Lewis, aka Drastic Dave, has come, or otherwise known as Drastic Dave, has come in. Obviously, he can't be blamed for these results, but it shows what a big turnaround project this is going to be. Much bigger than the Tesco's, which he did very well. I think some of the things that have been talked about is focusing back on those $13 billion brands that they have. However, there's a lot of stock and they're going to need to increase sales, increase marketing spend, but also probably dropping prices, which is a concern. It's also pretty bleak in terms of some of the outlook from Gen Z and that whole generation that are drinking less. So you're seeing volumes under pressure there, as well as prices. Also, there's the issue with GLP-1s and that impacting on consumer behavior too. I think sort of breaking it down, and what my view would be, is that you've probably got the best man in terms of the most capable operator to get back to basics with this business. He's got a lot of connections, particularly when it comes to the off-trade business and essentially forming better relationships with the supermarkets, for example. I think that's certainly something that he could build on. I think operationally, there's a lot of inefficiency in the business. We saw it at Unilever and we saw it at Tesco's, working with that. And when you do look at those $13 billion brands that they have, and they include brands like Smirnoff, Johnny Walker, Tanqueray, Gordon's, Captain Morgan, Guinness when it comes to beer, they are fantastic, top quality brands. And with the business at the moment trading at just 15 times earnings, I think the expectation is still pretty low. How long would a turnaround take if it can be delivered? I think we're probably talking more like a 4 or 5 year job, similarly to Tesco's. But for me, at that valuation, I think it still is a very attractive business. And when you compare it with your Brown-Formans and some US peers at 15 times forward earnings, with Dave Lewis at the helm, I don't think that looks expensive, although I don't think it's going to be a smooth recovery. I think it's going to be very bumpy along the way, and I'm sure you're going to see that reflected in the share price. But overall, I'd be holding my shares, and I do still like Diageo a lot. Sam, as a fellow Diageo shareholder, what are your feelings?
Pretty similar. I think Sir Dave hasn't really been in long enough to have made any impact. I do like what I've seen so far. I think to come in, the debt, I don't think it's a huge problem, but it's very, it could easily become a problem. To come in and just slash the dividend, I like that. Started dumping parts of the business that are lower margin or don't really fit in with those core brands. So, for example, in December, they announced to sell the shareholding in East African breweries and the shareholding in the Kenyan spirits business. And that's all being used to pay off the debt. He's got his ongoing strategic review. And I think that in conjunction with the fact he's already slashed the dividend, he is coming in. I think he's going to get the job done. I think you're going to end up with a much sort of leaner business that's focused on those core brands. A bit like, it's not dissimilar to what he did at Tesco, the job he's got now, which is obviously why they brought him in. I think if we compare these results, bearing in mind he's had less time, to the Unilever results we did a few weeks ago, where the new CEO's already had a year, I think I like what I've seen from Diageo more in the past 6 months than what I've seen from Unilever in the past 12. I don't know how you feel about that as somebody who holds both.
Yeah, no, I would agree. I think it's making, as you said, some of those big decisions early on, like cutting the dividend and paying down the debts, that they are positive steps. He's prepared to make those difficult decisions.
Yeah.
See how it plays out. But no, I do like the look of it. And seeing it at less than £15 a share now.
Yeah. But I think they've got the right man for the job.
Yeah.
If he comes and goes in a few years, I think at that point I'd probably have to sell it, because I genuinely think if he can't turn it around, you could be waiting a long time.
Absolutely. And I think they've done very, very well to recruit him.
Yeah, I would agree.
I don't know what his pay package is, but
I'm sure
if he turns it around, well worth it.
Absolutely. Right, should we move on to Mony Group?
Yes. So how are they doing in the big AI rotation?
They're doing okay. You wouldn't know it from the share price, but they have come out with their full year results, and revenue was up 2% to 446 million. Adjusted EBITDA was up 2% as well to 145 million. Profit after tax was up 1% to 81 million. Basic earnings per share was up 2%, and adjusted basic earnings per share was up 5%. Operating cash flow was down 7%, and net cash was down 51%. The dividend per share was up 1%, and they've highlighted resilient financial performance despite significant headwinds in car insurance. So for context, if we break it down a bit more by division, in insurance, revenue was down 1%, with challenging market conditions in car and home offset by strong performance in other channels such as life. Money grew 13% with good product availability and banking and improved credit card switching volumes. Home services grew 37% with a significant increase in energy switching, assisted by our first collective switch in 5 years, attracting exceptional provider and consumer engagement. Revenue from travel fell 22% during the half, with performance slowing in a competitive market. Cashback revenue fell 18%, with consumer confidence remaining subdued, impacting both retail spending and merchant marketing budgets as they focused on profitability. So for context, total revenue 221 million. Over half of that comes from insurance, 114 million. 53 million comes from money. 26 million, so about 12%, comes from home services. And then travel's much smaller, it's 6.2 million, and 25 million cash back. So about half the business is insurance, and then sort of just under a quarter's money, another quarter home services and cash back, and then very, very small amount travel. The adjusted EBITDA margins increased to 33%, and operating costs are down 4%. The £30 million share buyback executed over 2025 is now complete, reflecting the strong cash generation. And shareholder returns for 2025 totaled 96 million. And for context, that is on a market cap of 877 million. So that's over a 10% yield, including the buybacks. Plus a 5% growth in adjusted earnings per share reinforces the board's commitment to maximising shareholder value, allowing the group to further rebuild dividend cover. And they've announced a further £25 million share buyback, underlining their confidence as they head into 2026. They've helped households save an estimated 2.8 billion, contributing to a total of almost 12 billion saved for customers over the last 5 years. Super Save Club now has over 2.1 million members and is generating 16% of group revenue now and contributing to increased customer lifetime value expectations. For the outlook, they are expecting adjusted EBITDA of 146 million for 2026. So that's very slightly up from this year. And they've said the cost of pay-per-click marketing continues to rise, increasing 21% this year, on top of the 21% increase they saw at the end of 2024. Super Save Club will play a growing strategic role in reducing our exposure to these volatile and rising costs in the longer term. Obviously, it's not great at the pay-per-click because that's where a lot of the business comes from. However, Super Save Clubs now, it's come from nothing in the last few years to 16%. The more people they can get on Super Save Club, the less they're reliant on pay-per-click, which is by far the biggest expense. I think in the context of the pay-per-click increases, I think operating cost decrease of 4% is actually pretty good. I do like that strategy of the move to Super Save Club. In terms of the valuation, the business trades at a PE of 11 and has a dividend yield of 7.53%. It has had a poor year. In the past year, it's down 15%. The past 2 years, it's down just under 30%. The past 5 years, it's down 40%. In the past month, it is up 14% though, and that's mainly since these results came out. The main reason, as you can see, is not the performance of the business, which although it's not blowing the lights out, it's fine. And when it's giving such a good yield, that's all it needs to be at that valuation. I think the main reason for the share price performance has been AI concerns. I'm probably a bit less concerned about that. I think it is a threat. I think it's something to keep an eye on, but I just think we're quite a long way from a position where AI is significantly replacing the service that Mony Group provides. And I think it's at that good a yield that's arguably kind of more than priced in, really. John, as someone who's a bit less biased, what do you think of these results and concerns regarding AI?
It is a really difficult one. I would worry about the AI coming into it. The arguments against that, and I suppose making the case for a bit of a moat around companies like Mony Group, is that there's a large regulatory compliance aspect to it. So because of the law, you can't have ChatGPT just essentially doing all of the insurance comparisons for an individual and then them essentially clicking through that and going into it. There's a lot of regulation that Mony has to go through. And when you go onto their portal, you do have to look at a lot of the legal side of it and the agreements to click through. And you wonder whether that is essentially protecting them at the moment. I don't know whether that's something that ChatGPT, Perplexity, etc. could get around in the future. And the more that we do use the AI, I could see myself doing that in the future if it was easier. And then I didn't have to have, go compare Mony Group. And I think that is a significant concern. I'm obviously not doing that yet, and I would still be going on to comparison markets like Mony Group at the moment. But whether that changes in the next few years, potentially. So for me, I probably wouldn't invest for that reason. Although I think a lot of that is priced in with that huge yield you're getting. They're obviously returning cash to shareholders in the form of share buybacks too. So whatever that totals, 10, 11%, very, very generous. And even if they can keep that up for a few years, and if the worst case does happen, well, you have got some downside protection there. But I would be concerned. I think there's less of a moat for Mony than there is for Rightmove and Auto Trader. That'd be my bigger concern, I think.
What do you think about the valuation then? Because it is still cheaper than Rightmove and Auto Trader.
And I think that is probably reflecting it. I don't know. I don't think I'd have the conviction to go into it even at the current value. I think that would be my issue.
I'm quite happy holding, so we'll see what happens. Would I go out and buy it? I think maybe as part of a basket of sort of stocks that have been beaten up by AI concerns, but I'm quite happy taking the dividend for the next few years.
It's an interesting point you make. I own Rightmove, but if you're a new investor and you were looking at it as a basket approach and you bought Rightmove, you bought Relics, and you bought Auto Trader and maybe was it Walters Kluwer?
Yeah.
You could take a view that AI fears are overdone.
Yeah, Experian as well. Throw that in there.
Yeah, no,
You could come
Experian.
up with a good basket.
I think that basket is actually probably just Nick Train's portfolio. So
Yeah.
you might as well just go out and buy that. I mean, that would be the alternative, and then you'd end up with pretty much that basket. But yeah, we'll see, and time will tell on it.
Right, shall we move on to Aston Martin? Have they gone bust yet?
Not yet. I can't remember how many times it is. It's certainly high single digits in terms of the number of times.
007,
Historic.
isn't it?
Is it? Okay, it's something like that in their sort of circa 100-year history. Anyway, they had their full year results out, and revenue fell by 21% to £1.3 billion, amplified by a 17% decline in deliveries of its special models, and they carry the higher average selling prices, so pretty disastrous. Total deliveries fell by 10% to 5,448 cars. Underlying operating losses more than doubled to around £200 million, reflecting the fall in revenue and shift in the mix towards lower margin vehicles. Free cash outflows worsened by 5% to around £400 million due to the drop in profitability. And net debt increased by around £200 million to £1.4 billion. In 2026, car deliveries are expected to be similar to 2025's levels of 5,448, and underlying operating profit is expected to improve towards the break even, helping to reduce free cash outflows, so around an outflow of 100 million expected. And the shares rose nearly 3% in early trading. In terms of valuation, the group have a market cap of £401 million and trade at 0.33 times forward price to sales, compared to the 10-year average. Well, sorry, it's not 10-year average. It's an average since listing. I think that was 2018, the most recent time, of 0.98. And of course, they don't pay a dividend. I thought these results were very disappointing. I suppose to a degree, a lot of this is priced in, but they are really struggling. There have been production issues with the Valhalla, which is their really super premium, almost track type car. Apparently, they're being ironed out. So hopefully that's going to help push the margins up. But there's been reputational damage from that. There are headwinds in terms of tariffs, particularly in terms of the US. And yeah, the way that I see this business going with the debt on the balance sheet, it's at some point it feels like it's going to go bust for the 8th time. And I just think it's uninvestable. That being said, it's a strong brand, and I'm sure it will come back under some other ownership, but they haven't been able to turn it around, and it's just been getting worse and worse over the last 5 years. So yeah, I wouldn't go near it. I would one day like to own an Aston Martin, but I certainly wouldn't be buying shares in the company.
I totally agree. I think it's uninvestable. Just not good. I've seen they're selling the naming rights to the Formula One team for £50 million to boost its liquidity, which when you're hearing sentences like that, that's not good. It means they're running out of cash, cutting 20% of the workforce. I think unfortunately it's pretty clear in which direction this is heading. I can't see the Valhalla making a difference to that. They've already had production issues, and they were totally dependent, I think, on a perfect launch of Valhalla, which hasn't happened. Maybe they will pull it out the bag, but even then, when you factor in the tariffs and stuff, and their track record of not delivering on what they said they're going to do, it's more a matter of when rather than if they do go bust for the 8th time. Sorry.
Yeah. And shares down nearly 95% over 5 years.
But I think they can. Unfortunately, they can always drop by 100% still.
Yeah, well, that's right. And yeah, I don't know whether there's a James Bond film in the pipeline or not. That might help a little bit, but as far as I'm aware, there's not one coming out anytime soon.
Right, shall we move on to Rightmove, a business we both own?
Yes, Sam, how are they doing?
Pretty well, I thought. So they have come out with their full year results, and revenue was up 9% to 425 million. Operating profit was up 12% to 288 million. I'll just work out the margin on that. And that gives a 68.3% operating profit margin, which is ridiculous. Underlying operating profit is up 9%. The final dividend is up 8%. Basic earnings per share is up 15%. Underlying basic earnings per share is up 11%. They've highlighted that consumers spent a record share of time on Rightmove. The share of time remained strong at over 80%, according to Comscore. and over 70% according to similar web data. So it doesn't seem like on the market has made any kind of dent. Over 85% of the traffic comes direct and is organic. And they've got strong usage of a range of new consumer features, with several powered by AI. They've highlighted 24% more products and features released. Years of progressing their data and technology has enabled 31 live AI initiatives and products across the entire business today, including the most recently launched conversational search and app submission to ChatGPT. £90 million share buyback was announced today to be completed by July 26, and a final dividend of £50 million will be paid in May. So that 90 million buyback, that is on a market cap of now 3.52 billion. So that's about 2.5% of the shares. I like that it's going to be completed by July. I think they clearly think it's quite a reasonable price at the minute, so they want to take advantage of that, which is good to see. Average revenue per advertiser, that was up 6%. Total membership was up 1%, and 219 million of surplus cash was returned to shareholders through buybacks and dividends. And on the current market cap of 3.52 billion, that actually represents a 6% yield now when you're factoring in the buybacks. If we go on to the outlook, they've said that for 2026, they expect revenue growth of 8 to 10%, in line with previous guidance. And they're accelerating further their investment in innovation and value. Reflecting this period of investment, they expect underlying operating profit growth of 3 to 5%, resulting in an underlying operating profit margin of 67%. And they expect underlying basic earnings per share growth of at least 5%. In terms of valuation, it trades at a PE of 15.6 and has a dividend yield of 2.29%, but you are getting another couple of percent from the buybacks as well. I'm surprised how cheap this has got. I know we've been talking about it the last few weeks, but I think having now actually been through these results, these are a really strong set of results. The guidance is really strong. I've said it before, but having been through the process of buying a house, I can't see Rightmove being replaced by AI anytime soon. I find it really difficult to visualize. On the market doesn't seem to be much of a threat either. I really struggle to see something coming along and knocking Rightmove off its perch. And it does feel a bit like the baby has been thrown out with the bathwater. I think with Money Supermarket, you can see a scenario where Money Supermarket might have a problem. I think that's arguably reflected in the price. It's got some protection in the form of legislation, as you've talked about, John. I don't think Rightmove has those issues. I really struggle to see Rightmove being disrupted anytime soon. I think to get it at a P of under 16, when that yield is kind of effectively sort of, you're getting to 4 or 5% on it for what is essentially a monopoly, I think it's really, really cheap. I think you could make probably a pretty persuasive argument that it's possibly the most undervalued stock on the FTSE. I would go that far with it. I think it's really, really cheap for the quality and those numbers it's putting up. What do you think, John?
Yeah, no, I would agree with you too. I think it's got a deeper moat than Mony Group, and it's got the name, the portal. It's very easy to use. It's on smartphones, it's on tablets, it's on desktops. It's got some AI integration, which I wouldn't put a huge amount of sort of weight on, but I just don't see that going anywhere. It's been very, when we've had competitors coming into the market, it's fought those off really well. And it's able to continue to increase prices with that kind of operating margin. It's fantastic. And I don't see that changing. So I'd be tempted actually to top up on it at the current price.
Should we move on to Haleon? How are they doing?
Okay. Haleon, we've covered them quite a few times now. It's a spin out of the consumer health division from Glaxo a few years ago. They had their Q4 results out a couple of weeks ago with full year revenue growth of 3% organically against guidance of 3.5% to £11 billion, which was held back by low consumer confidence in North America and a weak cold and flu season. Underlying operating profit grew slightly faster than expected, increasing by 10.5% to £2.5 billion, and free cash flow was broadly stable at £1.9 billion, and net debt falling by around £600 million to £7.2 billion. 2026 organic sales growth is expected to be between 3 and 5%, with high single-digit increase in underlying operating profit. Medium-term sales growth guidance is now 4 to 6%, and the final dividend is going to be 4.9 pence a share, which takes the annual total to 7.1 pence, which is up 7.6%. And a £500 million share buyback has been allocated later this year. Shares were down nearly 5.5% following the results. In terms of valuation, Haleon has a market cap of £33 billion and trades at 19.6 times forward earnings, compared with a 10-year average of 17.9, and they have a prospective dividend yield of just under 2%. I thought these results were a bit disappointing. I suppose some of it is outside their control. They do sell brands like Panadol and those kind of over-the-counter remedies for coughs and colds. So weak flu season can impact on those things. But no, I think we've seen a bit better, kind of more of the mid single digits. These were below guidance. I think what they're doing sort of in terms of operationally, they are paying down the debt. The dividend is low in comparison with the sector as a whole in terms of the defensive sort of consumer goods sector, which seems sensible in terms of how they're allocating that. I know, Sam, you might say they should go a bit further on that front. Valuation-wise, for what it is, I think it is on the expensive side. And if I were looking at sort of consumer goods companies, we always come back to it on the show, but Unilever always looks a bit more attractive. Yes, it's a little bit, in fact, it's not more expensive. I think you've got better brands in there. The other big competitor is Reckitt Benckiser, which has been delivering a bit more of a turnaround, although the shares, similarly in terms of valuation, are probably sort of on par with it. So yeah, it's not one I would be going to invest in. I'm sure you could do a lot worse, but I think probably the turnaround does need to continue and hopefully get back to more your mid to high single digits to justify that kind of valuation. Sam, what are your thoughts?
Very similar. I think they've done a good job with it since it's been spun out. I think they've done well paying down the debt. I think they've done well reducing the operating costs. And I think the growth's not been terrible. I think it's a bit weaker this time, but overall it's performed better than I would have expected. I think in a few years' time, once that debt has been paid off more, once that dividend's up, it could be a business that you are actually discussing as something as quite a serious option if you are looking to add a consumer goods company. But I think at the minute, at a forward PE of just under 20, I just think why, when you've got so many other options available, I think you can just wait until that turnaround's completed. So for me, I think they're doing a good job with it. I think these results, I know the sales missed slightly compared to the guidance, but I think overall they're doing a good job with it and it's heading in the right direction. But I, like you say, I just think there's better options out there.
Fine. Okay. On to a company that you used to own.
I own it again.
Sorry. Okay.
So Wix is Wix.com, listed in America, which is the website builder. They have come out with their full year results and revenue was up 13% year over year to just under $2 billion. And all these figures are in dollars. And of that, creative subscriptions was up 11% to 1.41 billion. Business Solutions was up 18% to 583 million, and transaction revenue was up 19% to 255 million. Total bookings for the year were up 13% to 2.07 billion, and the gross margin was 68%, and that's split between 83% creative subscriptions and 32% business solutions. The net income was $50.6 million, which works out at 91 cents per share. Although the non-GAAP net income worked out at $7.95 per share, but the main difference is stock-based compensation. Net cash provided by operating activities was 582.9 million, while capital expenditure was just under 10 million, leading to free cash flow of 573 million. Excluding acquisition-related costs, free cash flow for the full year would have been 605 million, or 30% of revenue. They completed 575 million of repurchases of ordinary shares in 2025, underlying the commitment to share count management and returning value to shareholders. So that 575 million, for context, is on a market cap of just over 5 billion, so 5.137. So it is high. However, they do also issue a lot of shares to staff, so a lot of that offsets it. Although even then, the share count is coming down. And they've said Base 44 recently reached 100 million of annualized recurring revenue, powered by a fast-growing community of users, building everything from simple apps to fully customized business software. So Base 44, that was a recent acquisition, and that's basically using AI to kind of build websites for you. They've highlighted healthy mid-teens top-line growth anticipated for 2026 as we drive forward ambitious product roadmaps, including Base 44 and Wix Harmony. Harmony's demonstrating strong early conversion and monetization, driving new core Wix cohort bookings growth acceleration in early 2026. They expect free cash flow margin in the low to mid 20% range next year, reflecting the necessary investments to build category-defining products and fully unlock market opportunity. They plan to complete the majority of a $2 billion share repurchase program in 2026, which is absolutely massive on a market cap of $5.13 billion. I think even they can't issue that much equity to staff. And they've highlighted a $250 million equity investment led by Durable Capital Partners. And for a bit more detail on that, the company will issue 250 million of units to the investors at a purchase price equal to a 5% discount prior to the closing price of the day of the results. And each unit consists of one share and one warrant to purchase 0.25% of an ordinary share at a 25% premium to the current closing price. And the warrants expire on the third anniversary of the closing date. And for guidance, they've said for the full year, they expect bookings and revenue to grow at mid-teens percentage year over year, and free cash flow margin, assuming current capital structure and excluding acquisition costs, to be in the low to mid 20% range. In terms of the valuation, this is always a bit of a tricky one to value, but the PE is 100. However, it trades at 2.93x operating profit and only 8.82x the operating cash flow. I think these results are pretty good. I think in terms of the numbers it's putting up, you can't really knock them. I think the main issue is the dilution in terms of what they're issuing to staff. However, we've discussed that before, so I won't go into it too much, but they are now at a point where the buybacks are offsetting that. It's been really damaged by AI concerns. So in the past 12 months, it's down 50%. And in the past 5 years, it's actually down 70%. I think it's now really, really cheap. And I think they've positioned themselves as well as they can with Base 44, which they've not spent loads of money on, but when it's kind of sort of sitting alongside the core Wix business, seems to be performing quite well. The ARR is quite good on it already. I think the signs are actually very positive. And I think although they're priced as if AI is going to destroy the whole business, they could potentially be one of the beneficiaries of AI. So I think it's a really interesting business, and I'm pretty happy holding it and seeing what happens. John, what do you think as someone who's a bit less biased?
Yeah, no, it's an interesting one, and it's part of the market I don't know a lot about, because I hear a lot of amateur developers are sort of using Claude to do different bits of programming. I've never had a play with Claude, and I don't know how far you can get, for example, with your web design, with setting up an online shop, those kind of things, just using that, and whether that would sort of consume this whole kind of business model, or whether actually there's a bigger moat. The figures so far look good, and the valuation, certainly by historic standards, is pretty attractive and much lower. It's something probably doing a bit more research and actually maybe having a play with some of these tools to really get a feel from how far away it is. But as someone who's never used Wix or Claude, it's a bit of a difficult one to know.
I have had a play with Wix. I've never played with Base 44, so I can't see somewhere where I will, to be honest. In that case, of the 6 businesses we've covered this week, Diageo, Mony Group, Aston Martin, Rightmove, Haleon Wix, which do you like the most and which do you like the least? Good
question. I like both Diageo and Rightmove a lot. I think today I would go with Rightmove. I think it just hasn't done anything wrong, and it's more of a sentiment issue, whereas Diageo, you are relying on a turnaround. So I would be going for Rightmove, and then Aston Martin is an easy last.
I think without being boring, I would be exactly the same. I think Rightmove at the minute, I just think just such a quality business for what's actually a pretty decent price now. So yeah, I think they both choose themselves this week because Aston Martin's just uninvestable.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.